Good day, my fellow ABM students. We were about to discuss one of the essential part of accounting, which is the books of accounts. What is book of accounts? Well, books of accounts are the original records and books used in recording business transactions. Also, books of accounts refers to the finance records, ledgers, and journals that compose the company's accounts. The following are examples of business transactions of a company that are included in making entries. 1. Cash and credit sales. Are the company's sales paid in cash or on account? 2. Purchase of inventories. Are the company's purchases of inventories? 3. Acquisition of equipment. Are the company's gaining of equipments? And many more.
There are two major books of accounts. One is the journal and two is the ledger. Both plays a big role, for they made up the books of accounts. What is a journal? An accounting journal is a detailed record of the financial transactions of the business. Also, it is often referred to as the book of original entry, composed of the chronological record of all companies' transactions listed by date. Business transactions are first recorded in this book.
While ledger refers to the accounting book in which the accounts and their related amounts as recorded in the journal are posted periodically. Also, often referred to as the book of final entry because all the balances in the ledger are used in the preparation of financial statements. The basic form of the ledger is like the letter T, also called the T account. There are two types of journal, the general journal and the special journal. The general journal is the most basic type of journal, wherein all business transactions are recorded in chronological order. Special journal are used to record typical and similar types of recurring or repeating transactions.
The following are the types of special journals. Sales journal, used in journalizing all sales of merchandise on account. It is also a prime entry book used in accounting system to keep track of the sales of items that customers or debtors have purchased on account by charging a receivable on the debit side of an account. Receivable accounts and crediting revenue of the credit side. Cash receipt journal, used in journalizing all cash received including cash sales. Purchase journal, used in journalizing all purchases of merchandise on account or on credit. Cash purchases for inventory. Cash payment or cash disbursement journal, used in journalizing all cash paid including cash purchase. Why is journalizing important? Journalizing is important in the accounting process because, first, it shows a chronological record of the company's transaction. Second, it discloses the full effect of each of transactions per entry. It serves as check and balance tool of the company.
Ledger. As we tackled earlier, ledger refers to the accounting book in which the accounts and their related amounts as recorded in the journal are posted periodically and is often called as book of final entry because balances in the ledger are used in the preparation of financial statements. The same as the journal, there are also two types of ledger. The general ledger that holds all the information needed to prepare financial statements, and subsidiary ledger as an additional record to the general ledger utilized by the company to track the per individual accounts of the company's customers, creditors, and the like. Subsidiary ledger has a more soluble branch which are the accounts receivable ledger that is used mainly to track the individual account balances of the company's customer, and accounts payable ledger that is used in tracking individual accounts payable balances of companies' creditors.
Ledger, like accounting journals, also plays a significant role in bookkeeping. It contains essential accounting record for creating financial reports which are crucial for evaluating business health. Overall, books of accounts has a big contribution in the company's decision-making and financial reports for its external and internal users. Books of accounts are also crucial in ensuring regulatory compliance as they also serve as the proof of the business transactions reflected in the financial statements.